Taxes are no one's favorite topic, but their importance cannot be overstated. Tax policy affects every aspect of our financial lives, including how much of our paychecks, investment gains, and dividends we keep, in addition to directing our choices of retirement vehicles, estate planning considerations, and much more. Individual tax rates are historically low. Naturally, some investors also worry about how changes to tax policy will impact the stock market. This is especially true during a presidential election year, since the topic of taxes and government spending are politically charged. What history shows, however, is that while taxes might impact specific industries or asset classes, they have not been the main driver of bull or bear markets. In this context, there are three key facts investors should keep in mind when it comes to their investment decisions. When it comes to investing, the most important historical lesson is that the market has performed well in both high and low tax regimes. The U.S. corporate tax rates are now more competitive. Today's statutory corporate tax rate is low compared to historical levels. Of course, the effective tax rate that corporations pay is typically far lower than the statutory rate due to a labyrinth of tax breaks and deductions. Naturally, this is a politically complex topic. On the one hand, corporations are maximizing their tax efficiency based on the existing tax code, which ultimately is good for employees, shareholders, and the overall economy. On the other hand, this can be viewed as corporations not paying their fair share, especially when they are highly profitable, buying back shares, and keeping cash overseas. This is one motivation for the 15% corporate alternative minimum tax, CAT, for companies with roughly $1 billion in profits included in the 2022 Inflation Reduction Act. Debt as a percentage of GDP is near historical all-time highs. Many investors are worried not only about taxes, but also the level of government spending. There are only two ways to improve budget deficits: reduce spending and/or increase revenues. Reducing spending, especially non-discretionary items such as Social Security and Medicare, have been non-starters in Washington. Additionally, the government has not run a balanced budget since the Clinton and Nixon administrations, at the turn of the century and in the early 1970s, respectively. The bottom line? Taxes are low by historical standards, and markets have performed well across both high and low tax periods. Investors should maintain perspective and not overreact to tax policy changes when it comes to their investment plans. Thank you for listening. For additional information, please visit mraadvisory.com.